Last week I made a video about whether or not the worst fallen stocks in a market correction outperforms during the subsequent rebound, when investors start putting money back into stocks. I also wanted to look into if the largest stocks outperforms the smaller ones during this same time period. Is it better to be invested in larger stocks than smaller ones during a market rebound? The thinking goes that when the market sentiment switches from bearish to bullish, the investors that will be first on the ball are institutional investors, for example, hedge funds. And when funds with large assets under management, when they take significant positions in stocks, they need to care a lot about liquidity. That is the ease of converting your cash into stocks and stocks into cash without impacting the price. And large stocks tends to be more liquid. So to test how company size matters, I'm going to use the S&P 100 as a proxy for what we can call the mega caps. This is an index of the 100 largest companies in the US. And for the small caps, I'm going to use the Russell 2000. Then we're going to look at the periods after the S&P 500 starts to recover to see whether or not the largest stocks outperforms the smaller ones. For example, the last market correction seen in 2023, the S&P 500 was down more than 10% around October. Looking at the 2-week return during the rebound, the mega caps outperformed the small cap by almost 4%. Now let's do the same for all the other corrections we can find for the S&P 500 since the 90s. Each yellow bar here represents return for the mega caps 2 weeks after the end of each correction, and the gray is for small caps. Here is the average across each correction. Mega caps seem to outperform small caps in the short term. Let's do the same exercise, but instead of 2 weeks, we look at 2 months returns after market correction. But here on average, small caps has higher rebound returns than the mega caps. So the observation period matters if it's weeks or months. To see this, we can look at the average rebound return across the very short term and the medium term for both mega and small caps. So mega caps seems to have higher rebound returns when looking at the very short term. At first glimpse, this result seemed to be in line with the explanation I mentioned before. When the market sentiment switches, the stocks that will bid up first are the larger ones. These are more well known, investors are more comfortable with them, and it's also better liquidity. However, the difference between these averages is not statistically significant. You can check this when running a so-called t-test. We can't disregard that the difference we saw in rebound returns are just due to randomness and noise in our measurement. So no, I can't conclude that mega caps or small caps outperforms the other during a rebound with the data that I have. However, the differences in drawdowns during the market correction is statistically significant. During a market sell-off, small caps tends to have a steeper drawdown. On average, small caps falls around 24% during a market correction, while the mega caps falls 21%. So investors tends to sell off the smaller caps more ferociously during a market sell-off than the larger ones. And liquidity plays a role here as well. Small caps have also been more volatile when looking at performance since the 90s. The mega caps have outperformed. Most of the outperformance of the mega caps comes from the 90s and the past 4 years. But this is just a backtest and it doesn't tell us anything about what's coming in the future. To summarize, no, I did not find any significant difference in rebound returns between mega caps and small caps. However, we did see that small caps tends to fall more than the broad market during corrections. Thanks for watching. If you enjoyed the video, please don't forget to like it and subscribe if you haven't done so already, and I'll see you in the next one.